Good morning and welcome. Thank you for attending this morning's masterclass on tax and accounting as the financial sector prepares to transit from SOR to SORA before N 2021. I'm Ong Ai Boon, Director of the Association of Banks in Singapore. ABS has been working closely with the steering committee for the SOR transition to SORA and its 7 technical subgroups. The purpose of today's masterclass is for us to share with you the tax and accounting implications across the various product classes and businesses that uses SOR as it will be replaced by SORA. In order to get everyone on the same page in regard to tax and accounting impact on the 3 product classes, that is the derivatives, bonds, and corporate loans, which are either offered by your banks or used by your clients, we have invited the representatives to provide brief explanations on each of the 3 product classes first. And then after that, we will deep dive into the tax and accounting aspects. We will use the Pigeonhole portal, and you can submit your questions throughout the sessions, and then when appropriate, each speaker will address them. Otherwise, the questions will be addressed during the panel session at the end. And we would like to receive your feedback on today's session as well, so that we can improve future sessions. So please use the feedback survey that's available. The form is available through the same Pigeonhole link. So now it is my pleasure to introduce Mr. Yura Mahindro, Partner of Financial Services Assurance from PwC, to deliver the presentation on an overview of the IBOR reform. So ladies and gentlemen, have a good morning.
Thank you, Ai Boon. Ladies and gentlemen, it is my pleasure to be here with you today. And what we've noticed is with this topic, it is quite important, given the complexity and developments that happen, to really just have a session over the next 30 minutes to reintroduce the key concepts, what developments have been there since we last spoke to you, before going into the accounting and tax. So for the next 30 minutes, what I'll do is I'll really briefly recap what IBOR change has been about and reintroduce some of those key concepts. So maybe just a scene setter at the start. Well, clearly 2020 has been very heavily impacted by COVID-19, and for many of us that's been quite a challenge. And it has been a relief that regulators have provided some relief on a number of regulatory timelines that otherwise would have been imposed in 2021 or 2020. LIBOR change has not been one of those timelines that will be delayed. That's been quite clear, and I'll share why that is the case. So unfortunately, the message for all of us is really, in addition to dealing with the implications of COVID-19, we do need to address this particular point and quite key issue as we go over the next 12 months. There isn't a lot of time left, so we've worked out that if you looked at working days, there's only about 350 or so left and counting down. So really something that we do need to get on the table and start to look at and prioritize. As we look at this topic, maybe just a really brief view on why there is this change required. So as we all know, there have been historical issues around the LIBOR rate. So as most of you will know, the LIBOR rate is essentially an average of the major banks' funding costs. So typically what they will borrow from another bank on a 3-month basis without any collateral. So it's an unsecured borrowing rate for 3 months or 6 months and so forth. When we've looked at this particular rate over the last few years, what has happened is, in addition to the various historical cases of manipulation and so forth, the key issue has been that the liquidity in bank borrowing between 3, 6 months and so forth on an unsecured basis has just not been there. And with COVID-19, what the charts you're seeing illustrate is, if anything, COVID-19 had exaggerated this issue. So the chart on the left shows that if you looked at the contribution of the LIBOR rate, you can see that the blue line represents how much of the rate is really determined by expert judgment versus really the red lines where the rate is based on actual transactions. And you can see here that spike that happened in March when the COVID-19 stress was at its highest really led to a very high reliance on expert judgment. And this really galvanizes, if you like, the regulatory view that the problem will become a bigger one if it isn't addressed by the 2021 timeline. The chart on the right really highlights what happens with credit spreads and with interest rates. So you'll see that the green line illustrates what had happened between LIBOR and the US Fed fund rate, and you'll see that it had widened quite significantly in March this year. In contrast, we'll see that the US Fed funds rate itself had continued to dip down. So there's this question around should corporates and should people really pay a higher rate when there's a crisis like this, when actually the actions of the government were to bring rates down. So these two charts really highlight some of the case for change that regulators have put forward and the need to maintain the timeline that we have for 2021. I'm conscious with this topic, it is very easy to get into a lot of detail and a lot of people, and myself included, can get lost in it at times. So what we wanted to do is, just before we go through the key concepts, I wanted to take you through really a very high level, 30,000 foot view of what this is all about on a page. So if we start by looking at what it is, this change is about looking at the interest rate basis for loan, bonds, and derivative contracts, and it is a change to that basis. And the change is that existing market rates, so variable market rates, so-called IBORs or LIBORs, are not expected to exist beyond December 2021. They will be replaced by an overnight rate in most jurisdictions, and that means that rather than have interest calculated on a 3-month, basis where people are looking forward and saying, what can I borrow from another bank at 3 months? What will happen is we will change the basis to banks borrowing on an overnight basis. So it's a daily rate rather than a 3-month interbank borrowing rate. Because it's a daily rate, one of the concepts we'll touch on is that interest is now going to be calculated on a backward-looking basis for most contracts. That's because you have a daily rate, so it's difficult to say what is the rate going to be in 3 months. So we'll touch on that as we go through this presentation. And if we then think about what this change means for the organization, there will be changes to clearly the fact that you're now paying daily versus sort of having a 3-month rate could mean you need to collect interest rates more frequently. You might need to collect them daily. You might need to collect them more frequently than you've been collecting in the past. It can give rise to treasury risks. And from a contract amendment and negotiation point of view, legacy contracts that were referencing this rate, the old rates, may need to be changed and most likely will need to be changed to the new world. And for asset managers, there could be some implications to performance indices. As we'll touch on later in this session, from an accounting and disclosure point of view, there are implications to hedge accounting and loan modification in particular, with also a requirement to think about how disclosures need to be made to your investors and customers to highlight that this particular variable rate will disappear, particularly if you've issued corporate bonds and so forth that reference this rate. It's a very high-level view, but hopefully that's a scene setter as we go into some of these concepts in more detail. One thing to touch on is that for many corporates, and I know most of you are corporates in the audience today, one of the questions that we get quite a lot is how do we tackle this change? What should the change look like? And as the SC-STS has put forward previously, This is a very simple illustrative view on the kinds of steps that larger organizations will be looking at, larger corporates will be looking at to put in place. So it's really a self-assessment to say, have I thought about getting project funding to look at this? As a corporate, have I looked at quantifying my IBOR exposures? Have I started to understand what's in my contracts? Have I started to think about how my treasury risks might change? And then have I looked at systems, hedge accounting, treasury, and so forth. So those are some of the implications, and hopefully that slide is really just a snapshot of how you might want to be thinking about the change more holistically across the organization. So as we look at what is changing, just to recap again that you will see a lot of acronyms as we go into this new world, and most of you would have heard of some of these already. It has been quite simplistic to previously have LIBOR in many different currencies. And what is changing now is we will have every jurisdiction have an overnight rate with its own name. So you'll hear in the US of SOFR or SOFR, in the UK of SONIA, and similarly across a number of the jurisdictions that we've highlighted on this page. And we'll touch on Singapore and the changes to SORA in more detail as we go through the session today. On this page, we've also tried to highlight some of the three key features of these rates. So you'll see that all of the rates that we're moving to or switching to are overnight rates. And in most cases, the rates are transaction-based. So we're relying less on banks making judgments on what they think they can borrow at. The rate will be based on actually what did I borrow at based on transaction volumes. One point you'll note is that there is a difference between whether the overnight borrowing rate is secured or unsecured between some of these currency pairs. The reason there is a difference is coming back to my original point. The issue with LIBOR was really about the liquidity of borrowing on an unsecured basis on 3 months, 6 months, and so forth in banking markets. So as regulators have looked at, and working groups, industry working groups have looked at the change, what they've looked for is in these different markets, where is there greater liquidity? So if there is liquidity in an overnight market that is secured, then that is where the rate will move to. If it's where there's an unsecured overnight rate, that's where it'll move to. For all practical purposes, that difference, we're not really expecting a major price difference because it's just an overnight rate. And so for all practical purposes, I don't feel that's a major issue to dwell on, but one worth highlighting. As we go over the next 18 months, and probably counting down from that now, there are a number of milestones that are happening in different jurisdictions as industry working groups, regulators, clearinghouses, and so forth move forward to try and transition to this significant change. And what we've highlighted here are some of the key jurisdiction changes and timelines, and also work being done by ISDA. So ISDA is as many of you will know, is the body that is looking at contractual agreements for derivatives, and has the ISDA protocol that's been published is a way to standardize the changes across that particular body. And we'll touch on that as we go through the session. So that's a pretty key milestone. But if you looked at the rest of the regulatory, rest of the jurisdictions, you'll see that there are steps being taken in each jurisdiction to restrict new product on old IBOR references, so LIBOR loans and so forth, and also to promote clearing on the new reference rate and adoption on new reference rates. So that's the key message, and you're seeing these interim milestones being put in place across a number of the jurisdictions. So everyone is very serious about the change, and the next 15 to 18 months are quite critical. I wanted to go through some of the key concepts that we feel are quite important as we look at whether it's accounting, tax, or any of the implications of IBOR. So one of the first concepts is when we're looking at contracts, many of us hadn't heard of this term fallbacks until we started looking at IBOR. So I might just spend a moment to explain what these are. So fallbacks are contractual language that is there in all current or most contracts, so loan contracts, derivative contracts, and so forth. And what they refer to is the clause in the contract that says, when LIBOR is not available, then use this rate. So it is designed as a temporary clause for a temporary freeze in these LIBOR rates. But of course, now that we're looking at a permanent cessation of these old rates, so permanent cessation of LIBOR, there is a question about whether the existing fallbacks you have in your loan contracts are actually feasible. You might find that some of them will refer to things like, if LIBOR is not available, refer to cost of funds. Some of them will say refer to Fed funds rate. So they will refer to different rates depending on the contract. And so that is why we're seeing a need to go into looking at what contracts you have to understand what will happen when the rate disappears. I think it's probably fair to say that in most cases, the existing fallback may not be fit for purpose for you as a corporate or a customer. It may be because, as an example, if your fallback is to, say, cost of funds, it may be that if you're hedging that fallback, you may no longer be able to hedge perfectly a cost of funds rate with the new ISDA rate. Or it may be that the rate economically is not the same as the new rate. So for this reason, what we've seen is a lot of activity across the various industry working groups, so whether that's ISDA on the derivative side or a number of working groups of the LMA, APLMA, AIRRs, the Alternative Reference Rate Committee in the US, to look at putting out some draft language to help with coming up with new fallbacks that the banks will be talking to your customers on and engaging with you on, to really say, how do we get to something that is a better fallback and more fair? So if we looked at this, there are really two concepts that we wanted to introduce. Firstly, the fallbacks will, and we'll touch on this in the next slide, will introduce a way to economically compensate back to what LIBOR is, and that's the credit spread and term adjustment, which I'll talk about in a minute. But the other change is that if you looked at where the fallbacks are going, the derivative fallbacks are really looking at one structure, and that is to look at backward-looking interest rates. So you look back and compound your daily interest as a way of calculating your settlement. Whereas on the loan side, there are a number of options. There are options such as you can look backward-looking and match your derivative contract. You may be able to look forward-looking, although that's been the timing of that is uncertain at this point. Or you can pay interest in advance. So we'll touch on some of these concepts in a moment, but really the key point is that for derivatives, really standardized, a single sort of format. For loans, there is some different options that are being made available. So I wanted to touch on really this concept of economic equivalence. So why do we need these things that we've touched on in the previous slide around a credit spread adjustment or a term adjustment when we move from LIBOR to the new risk-free rates or reference rates? The chart on the very top, so the graph on the very top, sort of highlights what most corporates will see today when they're borrowing, when they have engaged in typical borrowings with their banks. So on a variable rate basis, your typical structure would be 3-month LIBOR plus you negotiated a spread or a customer margin with the bank. And so that comes up with your all-in customer rate. So your typical borrowing contract would look like 3-month LIBOR plus, say, 1.5% to give you a customer rate. The issue as we transition to the new rate, so if you've got that contract and it now exists up to 2030 or a long-dated contract, so it's got 10 years to run, the issue is when LIBOR disappears, say at the end of next year, how will we get to an equivalent point to what that 3-month LIBOR rate is? So when we look at that particular point, there are two things within LIBOR mechanically that don't exist with a new reference rate. So those two things are, firstly, the 3-month LIBOR rate is 3 months, so it has tenor, whereas the daily rate is an overnight rate. So when we're thinking about adjusting or compensating for that, the first thing we need to do is compensate for that tenor. The second thing we need to do is the 3-month LIBOR rate involves a credit premium. So it involves the bank credit spread that existed. And as we move forward, the daily rate has very little. As we talked about, it's usually secured. And even if it's unsecured, it's 1-day rate. So there's very little credit risk that's inbuilt into the rate. So there needs to be an adjustment for that credit spread. So those two things are the reason why we've had the discussions in the previous slide, where we're looking at as we move from legacy instruments to new instruments and talk about fallbacks, we need to adjust for these 2 points, so credit spread and term structure, to get to something that approximates economically the old LIBOR rate. The second concept, which we've touched on and I wanted to really just expand on, is this concept, and we'll use simple language, so forward-looking coupons versus backward-looking coupons. So if we looked at your typical variable rate contract today, so you looked at a LIBOR rate, whilst it's a variable rate, in practice, it's actually sticky for 3 months. So what that means is, if you set LIBOR today, so if you entered into a contract or a loan contract today, and LIBOR was, let's say you locked in a rate at 1.5% for the next 3 months, so you know what you're paying. If there was to be a significant volatility in the next 3 months, you're actually fixed. So you're actually, you're fixing for 3 months, then resetting, right? So you've got this sort of fixed, reset, fixed, reset. It's not truly variable. And it's being done on a forward-looking basis. So what happens is, at that point in time, when the rate is set, because it's based on what the banks think the rate will be that they can borrow at for 3 months' time in the future, it has a forward-looking element to it as well in the way that it's priced. With daily interest rates, that's not possible at this point. So the way that interest calculations will work is that they will be backward-looking. So so let's say we're at 30th of September. In the old LIBOR world, what we would do is we would look forward and say, okay, my next payment due at 31st December is, say, 1.5%, because that's what the forward-looking LIBOR rate is. As we look into the new world, we don't really have a forward view of these daily rates yet, until the derivatives markets develop and so forth. So what will happen is we need to wait until 31st December, then look back and effectively compound the daily averages, or average the daily rates, to get to what the rate should be at 31st December. So that's quite a key point, and I know a number of corporates have looked at this and tried to grapple with it, but if there's one key element to take away for most corporates today, that would be this difference, this nuance around where you're looking forward for LIBOR versus when you're looking backwards and adding up or averaging the daily rate. Now, the issue that creates, of course, for a number of corporates is that you may not know the interest, you won't know the interest until you get very close to the point at which you have to pay interest. So there are a number of mechanisms that are being introduced to deal with that particular point. And I'd love to say that those are standardized across all products, but they're unfortunately not. So what we've got on this slide, and I apologize for the seeming complexity of it, but I'll go through it, is a number of mechanisms to give buy-side corporates, asset managers and so forth, some time to deal with, I've just realized what my backward-looking rate is, here's my time to work out how I can pay. So how do I get to a delay before I make that payment? So if we look at a number of the different conventions that are being introduced, and you'll see them across different products, the first one is really an observation shift or look back. And again, we encourage you to discuss these with your banks. But really what this is it's shifting the 3-month window back where you have observed the daily rate and averaged the daily rate. And that might be moved back by 1 to 5 days. And that gives you a little bit more time to then pay the interest. The second concept is a payment delay, which is really you get to the 31st of December, and then you pay interest literally 2 or 5 days after that. And the third concept, which I did want to dwell on because it can sound like it's a forward rate, but there is a nuance, is a product that in particular in Singapore is being introduced. And this is a compounded in advance rate. What this is will be you still look backwards and look at the daily rates, but you pay interest in the next month, if that makes sense. So if you're looking at the interest rate in December, you've averaged all of the last 3 months, that will be the rate you pay on 31st January. So effectively you have a wider window before you pay that rate. So these conventions are just worth bearing in mind as we go through, because they're not completely standardized across all products. They can vary, and you would need to think about them for your settlement systems and so forth as you go forward. I just really wanted to briefly touch on some of the Singapore specifics, but I won't dwell into them in a lot of detail because we will go through them as we go through the product specifics. So briefly, in Singapore, as many of you are aware, the current SOR rate is based on the US dollar LIBOR rate swapped back to Singapore dollars, and we look at the forward points to really calculate what this rate should be. So this is an unsecured rate, and it's really, again, a forward-looking type rate. And the new SORA rate will be a local overnight borrowing rate that is not dependent on the US dollar forward points anymore. And that's where all of the activity is at the moment in Singapore to develop this market. And we've touched on this slide really just some of the activity that we've started to see on derivatives and cash markets to build this market up rapidly. So we'll touch on that more as we go through the product sessions. But that's the key change in Singapore. One point to highlight with this change is that the change is not exactly the same as what we're seeing when we look at fallbacks to some of the other markets, say the US market. One of the concepts you might read about and hear about is a fallback rate SOR, or also previously known as adjusted SOR. What this is as this change has taken place, and as we've looked at this change, when we look at the US markets, the view was, okay, if we're going to go from US dollar LIBOR to SOFR, then what we'll do is for the fallbacks, we will introduce essentially a change to introduce SOFR plus credit spread plus term spread, right? So you're introducing a change on your legacy contracts that references directly the new rate that is coming in that environment. For SOR, it's slightly different because we've got some complexity where we're moving from a US-derived rate to a completely local overnight rate. It is too much of a change to go straight from legacy SOR contracts straight to SORA. So for certain contracts, you will have a fallback where you're not able to repaper that legacy SOR contract directly to a SORA contract. You will have some of these SOR contracts that will reference another rate called fallback rate SOR before over time transitioning into SORA. So that fallback rate SOR calculation we'll touch on as we go through these products, but I wanted to just highlight that as one of the differences compared to particularly the US dollar LIBOR transition, where effectively you have really just two rates to think about. For some of you in Singapore, you will have to think about SOR going into fallback rate SOR and then SORA. We don't think that'll be a very big percentage of the contract volume because we feel that most contracts should be able to repaper, so you should be able to just change the contract from SOR to SORA. I also wanted to briefly touch on SIBOR, and again, we'll dive into it in a little bit more detail through the product lenses. But with SIBOR, there is a proposal that has been put forward to also discontinue SIBOR, albeit with a longer window, so 3 to 4 years for the discontinuation. So the reason to highlight it now is really to say that please start to think about SIBOR as well in your IBOR reform projects. And also think about this change as you're starting to look at new products, and if there's a way to discontinue new SIBOR contracts and think about SORA, that might be a case worth considering. Okay, so that was a run through of what I hope was introduction, but also a recap of a number of the key concepts on IBOR change. I'll now just pause for any questions that might have come through. So the first question is, what does it mean when we say a particular reference rate is secured or unsecured? So thank you for that question. So when we looked at what these rates are, so when we look at the overnight rate, it is referencing borrowing transactions. So the question is, are those borrowing transactions collateralized or not collateralized? That is secured or unsecured. So in the US market, as an example, when we look at an overnight, the US SOFR rate, it is referencing a collateralized overnight lending agreement that banks will have. So they borrow overnight and they post treasury collateral, and that is the rate. So it's a more risk-free rate, if that makes sense. If you looked at some other markets, there would not be that collateral. It would just be an overnight borrowing. I just borrow 100 million and I'll give you back 100 million the next day. There is no exchange of treasury collateral. So that's the nuance. As we've touched on, for most corporates and for most of the buy side, we don't see that as a major difference. Just pause for any other questions that might come through. Very good. Okay. I will now transition to Matthew to take us through some of the work on derivatives in particular.
Thank you. Good morning, everyone. So I think one of the objectives we want to achieve first is to give you a quick run-through of the different product streams that are impacted by the transition. So the first product we will review is on derivatives. And if we could just switch slides, please. Thank you very much. I'll just take it over. Thanks. So as mentioned, there will be quite a few definitions that everyone needs to be familiar with, because this transition can give a perception that things are going to be very complex. And I think making sure we all understand the vocabulary and the implication behind it is obviously quite important, and we will try as much as possible to spell out those acronyms to make sure that everything is very clear. So currently, the Sing dollar derivative market is based on a rate you are most familiar with, which is called SOR. As mentioned, this rate is actually FX implied. And what does it mean? It means in practice, we observe a dollar-denominated rate, and until now, this rate has been US dollar LIBOR. And we create a synthetic Sing dollar rate, which is basically converting that dollar interest rate into Sing dollar via the FX swap market. So quite naturally, as LIBOR is on track to be discontinued at the end of 2021, SOR simply can't pursue to exist in its current form. So it needs to be converted to something else. Additionally, in line with all developed markets, Singapore will actually adopt a new benchmark based on an overnight rate, and that rate is SORA. SORA stands for Singapore Overnight Rate Average, and it's a rate that we've been observing for over 15 years. So it's something that's very well established and that will become the new benchmark for derivative transaction. So now we need to ensure that transition from SOR to SORA is done in an effective manner. And I think two ways are going to be available to do that. One is an active phasing out of SOR exposure, meaning unwind, repapering, restructuring of existing contract to make them refer to the new SORA benchmark. So that's one possibility that is, I would say, strongly encouraged because it solves all benchmark problems once and for all. It might not be applicable for every situation, and especially for derivative, there will be the concept of fallback that will apply via a rate that used to be known as adjusted SOR, which we need to stop using, but I'm just using one last time to explain what it has become. It has become fallback rate SOR, which is a terminology you will see for all rates being transited out. So we'll share a bit more details on the methodology and the publication. So of course, to be able to transit to a new benchmark, which is SORA, we need to have the right infrastructure, the right liquidity, the right contractual framework. So this slide is really here to help you have a very quick snapshot of the development to date. And I think since we last presented to all of you back in February this year, markets has been developing pretty fast with key milestones being achieved across different instruments. So I think first, a set of market convention has been defined, which is very important to first develop the interbank market. Most banks in Singapore are now in a position to quote SORA-based derivative, and these prices will be available in most brokerage screens, as well as data platforms such as Bloomberg, Refinitiv, and others. So that aspect is very important, very crucial, so that the availability of data is properly spread across all market participants. One element that will really help everyone is the new index that has been published by the MAS. You will see it as a SORA index or compounded SORA rates. So I think the compounding aspect, the fact that we have these daily rates that we need to compute and compound, can scare market participants quite a bit. Because even though the computation is not that complicated, it can be complex enough to pick the right dates and do the right calculation. So the MAS has published an index that you can actually refer to for your contracts, whether derivatives or loans or notes. And the benefit is that it will, for example, ensure that you have no mismatch between a loan you have taken and a swap you have entered into, because both can refer to the same index. And unlike LIBOR, they won't fix in advance, but very much like LIBOR and all rates you're familiar with, they will be available for 1 month, 3 months, 6 months. So you will have fixing screens for rates of a given tenor, something all of us are familiar with. Of course, building liquidity is important. We can't encourage market participants to move to SORA if there is no liquidity. So the first trades were closed a few months back now. Clearing and infrastructure to facilitate the interbank activity have been developed. So the first clearing trade was done in May 2020 on LCH. And again, all banks are now ready to, or most banks are now ready to quote on SORA. The MAS is facilitating auctions to ensure the liquidity builds up. So I think that's very important, and that will be a key point so that everyone is comfortable moving to the new benchmark. The legacy transition will be quite important, and I think we'll discuss that in a slightly more detail on the next slide. But the publication, for example, of fallback rate SOR will start very shortly. The methodology has been announced in August, so I think that's again something that will give comfort to all market participants on the clarity that is available with regard to the market development. In terms of industry readiness, so we have organized, I think, this forum today. There was previous presentations and a lot of engagement from the different working groups. So I think it's again quite important. A lot of publications are available either on the MAS website or on the ABS website. So I think we encourage you to reach out to these sources. A lot of frequently asked questions are available there, and you will notice that you are not alone in this situation. A lot of participants have very, very similar questions. Some of them don't have full clarity on yet, but a lot of them are actually very clearly scripted. So I think it's important, again, that you are confident about the amount of information you can access. In order to get ready, I think I just want to flag a few key elements. So I think today's focus is on hedge accounting, and obviously not just hedge accounting, but in accounting and hedge accounting in particular. And one potential big challenge is around potential mismatches between underlying loan or underlying bond and the corresponding derivatives. So I think that's going to be one of the big challenges. One point I want to flag specifically from the derivatives angle is that derivatives have a bit more flexibility. So if you want to do a compounding, obviously that's possible. If you want to delay your payment or if you want to shift your observation period, it is also possible. If you want to do a simple average instead of a compounded, it's also possible. So there are a lot of small tweaks and variations that are possible in the derivatives market, for which I encourage you to discuss with your banks to make sure you can adapt or match your underlying with your derivative. So I think that's an element that's very important. And again, using the MAS SORA index is a very simple and easy way, especially for new contracts, to make sure there will be no mismatches between the two contracts. Another element is going to be around the ISDA protocol. So one of the big challenges beyond the financial aspect is going to be on the contractual aspects and eventually the repapering and ensuring that your contracts can go through the transition without any issue. So the protocol that ISDA will publish very shortly is a very simple and effective way to incorporate the new SOR definition with the new complete fallback into your ISDA. So rather than having to negotiate with your 10 or 20 banks, you can simply adhere to the protocol. And it's pretty clear that most banks will adhere to the protocol as well. And that means it's simplifying one step of contractual repapering into almost something as simple as a click on a website. So I think that's something we strongly encourage you to look at. We've shared the detail of the fallback rate SOR, and I will just finish on that point. Fallback rate SOR is going to be here to ensure there is no contractual breakdown on your derivatives, but it is not meant to be a new benchmark. So it's very likely that there will be a very limited amount of market on that benchmark, if any. And that rate itself, as it was announced in September, well, earlier this month, basically, that rate itself will have a limited shelf life. So it can only be seen as a temporary solution. And again, we strongly encourage everyone to shift to SORA directly as much as possible, as it will be a definitive solution with regard to this transition. So I will stop here, and I will take a couple of questions.
Thank you, Matthew. We've got a few questions coming in from the audience. So the first question is, will my LIBOR swap that matures after 2021 need to be unwound, or will it be transitioned to the new reference rate?
Okay, so that's a very important question. I think it's valid for any rate with any benchmark for transactions crossing the end 2021 deadline. It is a very important point because in some cases, if you take absolutely no action, your contract can become frustrated, meaning that there is no reference we can point to define the rates you have to pay or receive. It doesn't mean you need to do complicated repapering. The ISDA protocol is a simple way to get that sorted, but still there is some action to be taken, and no action is clearly not recommended. On the unwind point, clearly you do not have to do that. It could be a possibility, but you can do a simple repapering or amendment of your contracts.
Thank you, Matthew. We have one question on ISDA protocols, and this relates to the previous ISDA protocol. So what does the ISDA 2006 swap definition provide for IBOR transition? Move from the IBOR straight to RFR or IBOR to the fallback?
Okay. So again, that's a very important point. So when you sign contracts, you are referring to the then prevailing ISDA definitions. And these definitions were not, I would say, catering for a permanent discontinuation of LIBOR. Hence, we have now new definitions but they can't automatically apply to your existing contracts. You need to agree with your counterparty to change to these new definitions. And that's really what the protocol is achieving. It's just saying, we have a set of definitions. These definitions are not complete. They do not cater for permanent discontinuation of LIBOR. Let's shift to the new definition, which are incorporating the new benchmarks.
Thank you, Matthew. We did have another question on cost of fund rates, but we might save that for SG3. So thank you, Matthew. So maybe just turning to Kipong from SG2.
Thank you very much, Yura. Good morning, everyone. Today, I will talk about bonds and perpetual securities, which would be impacted by this transition. Right, I will largely be talking in about 3 areas. So the first one would cover legacy Sing dollar bonds. The legacy bonds comprises of 3 main types of fixed income securities. The first would be the area of floating rate notes. That is currently about 2.4 billion outstanding. The second type of securities would be fixed rate and resettable rate notes. These are mainly bank capital tier 2 notes, and thirdly, perpetual securities. Fixed rate resettable notes will account for about 10.4 billion, and then perpetual securities around 20.5. In total, then you would have about approximately 33 billion outstanding, and that covers or comprises 87 legacy Sing dollar bonds, right? Versus, for context, versus a total Sing dollar bond volume which will mature after 2021 of about 136 billion. In terms of what the bonds and perpetual securities subgroup will have been working on, is one, of course, engage market participants, on seminars and webinars such as this for education and awareness. We have also developed and are keeping track of the legacy issues and engaging those legacy issuers as to what they should be thinking about and doing next, and then determining the transition next steps with these legacy issuers. Of course, thirdly, then to understand any other impact that could arise on regards to these legacy bonds as they transition to the new SORA reference rate. The second area would be around early adopters, right? Given that SORA is the new reference rate to replace SOR, issuers who want to issue debt securities based on the new reference rates would have to understand, one, what are the changes from going forward, new areas which they need to think about, particularly conventions, and how to go about issuing SORA bonds, right? There would also be testing of internal processes and accounting systems. As Yura had mentioned, there is likely to be more monitoring because it's a daily overnight rate. So new processes and accounting systems, internal systems, need to be able to help with the tracking, efficient tracking and accurate tracking of that. And of course, certainly when all these things are ready, then these will facilitate the adoption of SORA as a new floating rate benchmark for fixed income securities. Right. So at the moment, in terms of early adopters, MAS has already issued its FRNs, and DBS was the first bank to issue a SORA-based note. And certainly, in terms of other adopters, banks and other corporates are also potential issuers. Right. It is imperative that establishing early activity and momentum for these new reference rates, both in the cash space, which is bonds or fixed income securities, for example, and activities in the derivative markets, would be key to developing a deep and liquid SORA market. The third area I've mentioned is really to have internal systems ready for when this transition happens, and there needs to be some time put aside to prepare for this. Right? Webinars such as this, sessions such as this, to talk about tax and accounting matters, for example, would be important in the preparation process to have your own internal systems ready, your understanding in a state of readiness, as well as being ready to execute either fixed income activity or derivatives or even bank loans. So in the area of the new benchmark, interest accrual, we've touched a little bit on it already. It needs to, needs to be understood and also put into practice. It is backward-looking and certainly quite fundamentally different from what we're used to under the LIBOR regime, which is more in advance. Right? Incorporating adjustment spreads to it, we've also touched a little bit about that. Given that there's a move to a new reference rate, there is also adjustment to think about in terms of credit and term spreads. Valuation of bonds, for example, in the secondary market, would also be an important consideration for both issuers and investors alike. Right? Tax and accounting considerations, gain or loss, in P&L when transition happens, or how do investors and market participants look at valuation as we move forward once the new SORA benchmark is in place. Right? Things such as fair value adjustments, P&L changes would also have to be considered. Other considerations, Matthew has touched upon hedge effectiveness, particularly when bond issuers or bond investors have overlaid a derivative over their underlying fixed income instrument. Yeah. So with that, I've touched on the three areas already in terms of how do we look at look at legacy bonds in the Sing dollar space, how we could encourage and promote early adopters, and thirdly, how do we get ready in terms of preparedness when the transition occurs. Thank you. Let me hand over to Yura.
Thank you, Kee Pong. Got a bit of interest, so a few questions have come through. The first one is, so SOR is used to price Sing dollar bonds and also in the reset formula for perpetual bonds. How will pricing and resets be done when SOR is discontinued?
Yeah, that's a very good question and a very natural question. Ideally, if you have an equivalent reference rate that can be along the lines of SOR, so here that's where we look at the term structure of interest rates. So if there are term rates available, and the market can use that. At the moment, term SORA, lack of a better description, or term rates based on SORA is still being worked on. They could come about sometime in the future. And so that's something that a space to watch. In the event that takes a bit longer, or it could be that it does not happen, then in terms of how the market can think about fixed income instruments is, if it's fixed rate, you can always price based on a fixed rate or yield basis, or price or yield basis. That's something already understood by the market. It's just getting used to in terms of how market thinks about bond valuation going forward in the new reference rate environment. They could also, like other markets, use other references like treasuries, for example. Right? So for pricing, once the fixed rate bond is priced, then the coupon remains unchanged regardless of the reference rate. Of course, in the area of floating rates, which in the Sing dollar space, it's more of an exception than a norm, because primarily in the Sing dollar space, the market is a fixed rate market. Because currently there are 4 floating rate instruments that are outstanding, right? So to the extent that happens, it will be based on the SORA reference rate already, whatever is available at that time. right? So that is kind of how the market could adjust. Of course, there's some adjustment, but I think it's an adjustment that is not new to them in terms of concept and approach. Right? It's just now how would the market then use that as practice, as ongoing forward practice.
Keep on. One more question. I have an existing medium-term note program. What do I need to update in order to issue SORA bonds?
Okay, if you have if you have debt issuance program already up, then there are two main areas you need to look at. The key documents clearly are the terms and conditions within the program. You would need to add in a wedge that would be describing the issuance of SORA bonds and the conventions thereof, right, and associated terms. You will also need to update what the concept that we talk about in terms of a fallback, right? Of course, currently when we go into a new reference rate, it is quite unlikely that the new reference rate will change, or be updated to a new one in any time in the near future. But of course, that could happen. So what issuers need to do is to have a fallback rate language that would be future-proof, that will be able to cater for future changes in the reference rate. So that would allow you to be, one, ready to issue bonds based on SORA. Two, also in the event sometime down the road that the reference rate gets changed again, then your documentation will be able to cater for that change with no or minimal repapering.
We've got a fair few questions coming through, so maybe two more. What is the longest reference rate available for SORA? If I wanted to issue a 30-year bond, is there a reference rate benchmark available?
At the moment, term rates for SORA are not yet available, because SORA right now, what we do have is an overnight rate, and that's backward looking, and that has been around for quite a number of years already. MAS is also publishing SORA indices, so that at the moment is kind of at 30, 60, and 90 days, right? For longer term, as I've said, you could always price on a yield or price basis. You could also use a treasury reference, which is common in the US dollar market. In Sing dollars, there is SG-STS as an example, and the SG-STS tenor go up to 30 years, right? So you do have a term structure of interest rates for Sing dollars, so to speak. But I have to say that when it comes to the derivative space, SG-STS is not really used to hedge fixed income profiles, right?
Thanks, Kipong. Last question. I have, apologies. Sorry, I can't, we've just lost that question. Noted that the recent perps and bonds are still issued off SOR as reference rates. Why are they not done off SORA given the impending discontinuation?
Yes, that is a work in progress. We have sent out in July to the legacy issuers, informing them that this would be coming and they need to be prepared for it. So, of course, it does not just relate to bonds, it also relates to derivatives as well as loan products, right? So for issuers, they need to think more holistically and as to how they can be prepared for this transition. So that, as I mentioned, that the communication went out to our legacy issuers. We will also, through various means, communicate to issuers in general, right? But of course, as I mentioned, bonds is one product, but this reference change touches on all corporates and all business entities in that sense. So a holistic approach is what we would recommend, that will cover how would a company look at derivatives, their loans, their bank loans, as well as their debt securities. We are planning to have a compendium of conventions out across the various products. That is envisaged to be end of September. So once that is ready, that would be another step whereby we can engage the corporate clients and on a much focused approach so that they can then home in on debt securities, on derivative areas as well as loan areas. Right. So the work is still ongoing. We would be starting that on a more focused front, as I said, in the fourth quarter and going into the first and second quarter next year.
Thank you, Kee Pong. Maybe turning now to Jonathan from SG3.
Thanks, Yura. Good morning, everyone. It's very nice to address everybody today. I represent Subgroup 3 of the Steering Committee for SOR Transition to SORA, which focuses on the transition of business and syndicated loans from the SOR to SORA benchmark. Subgroup 3 comprises of 16 banks, including the 3 local banks, as well as foreign and global banks who are participants in the Sing dollar bilateral and syndicated loan markets. The mandate of Subgroup 3 is threefold. First, to develop an appropriate solution to transition existing SOR loans to SORA. Second, to provide the recommended conventions and other operational and infrastructure required for banks to originate new SORA loan products. And third, to drive early adoption of SORA through pilots and other similar types of lending programs. So those are the 3 objectives of Subgroup 3. Today, I'm going to go into those 3 objectives one by one to give everybody kind of a flavor of what's been taking place in the business and syndicated loan market where it comes to SOR transition to SORA. Yes. First, I'm going to talk about existing SOR loans. So whenever we have a panel such as this one or a webinar, this is one of the first questions that we have. What should I do about my existing loan that references SOR? What will happen to this loan when SOR discontinues at the end of 2021? Well, as MAS shared with us early last week, at the industry level, there are 90 billion Sing dollars in SOR-linked loans maturing after 2021. So that's quite a material set of exposures. And broadly speaking, the subgroup has discussed 2 approaches to addressing existing SOR loans. The first is to switch to an alternative benchmark, in other words, to refinance before the SOR rate discontinues at the end of 2021. The second is to amend the existing contract language in the SOR loan, catering for benchmark discontinuation. This is the language that Yura mentioned earlier called the fallback language, which gives you the rate to which the loan contract falls back when SOR discontinues. So the second approach, to amend, means that you change the contract language now, but other than that, the loan continues all the way until SOR goes away, and then the fallback kicks in. With regard to which one of these approaches you may want to adopt as a borrower, that will depend on your specific situation, and I encourage everyone tuning in to have a conversation with your bank about the appropriate approach for your existing SOR loan. So one example of what I mean when I say it depends on your situation is, for example, if your loan is hedged, then it may make sense to avoid hedge ineffectiveness for the loan to be amended to fall back when the derivative falls back. which will be closer in time to when SOR discontinues. So depending on these specific dynamics related to your exposure, that will drive your decision of whether to switch or to amend. So I encourage everyone to have conversations with your banks about the approach that works for you. The Steering Committee for SOR Transition to SORA, the SC-STS, plans to publish recommended fallback language to support the amendment of SOR referencing contracts in the third quarter of this year, which I recognize is coming rapidly to an end. So we may publish it in the October timeframe, but definitely the plan is to publish these recommended fallback languages very soon, so they can be inserted into contracts to be amended. The SC-STS is also working on an industry approach for lenders to transition existing SOR loans to SORA or another appropriate alternative benchmark before the end of 2021. So in other words, there will be a recommended approach for all banks to adopt rather than leaving it to individual banks to renegotiate with borrowers, which creates more of a can create more of a confusing situation. So the intention is very much to have an industry approach to transition before SOR ends at the end of 2021. The next thing I'm going to talk about is new products, new SORA-based products. So that is where I'm going to take reference to some of the more technical terminology that Yura introduced a bit earlier on. Terminology such as in arrears and in advance. So these are new products that have already been piloted by banks in Singapore using these two different types of structures. So in May, about a few months ago, if you were to go to Google and type in SORA loan, you would come up with nothing. And if you were to do so today, you would come up with a large list of hits of news articles covering these loan pilots that different banks have undertaken. So I'm going to talk about these two different structures. The first, compounded in arrears SORA. Now, the reason there are two different structures that banks have piloted is that in discussions with each other, and as well as in early discussions with customers, we have come to understand that customers have different priorities where it comes to the preferences that they have with regard to their interest rate benchmark. And so these two different approaches are here to cater to these different preferences. So first, I'm going to talk a bit about compounded in arrears SORA. To talk about these two approaches, I'm going to refer to the diagram on the right-hand side of this page that shows the dynamics of interest calculation in a compounded in arrears loan and in a compounded in advance loan with an interest payment that is due at the end of February. So the diagram on the right-hand side shows 3 months. The interest payment is due at the end of February. The loan is disbursed at the beginning of February. So let's talk a bit about compounded in arrears. So as Yura and Matthew indicated a little bit earlier on today, compounded in arrears is calculated using the daily SORA overnight rate by calculating a compounded average of this overnight rate that is used to set the amount of interest payment that is due at the end of the month. So in this case, if you were to have such a loan, a 1-month loan, drawn down at the beginning of February, on the 1st of February, then at the end of February, around the 28th of February, the interest from the daily SORA rates published throughout the month of February so more or less you have about 20 data points from 20 business days, will be compounded and averaged, and will be used to calculate your interest payment. So obviously, this does not give you a huge amount of time, an amount of advance notice of the interest payment, because the interest is due at the end of February, and the payment is calculated by averaging the rates published on every day in February. So this approach is for customers who are a bit more comfortable not knowing the exact interest payable in advance, and for whom hedging is a priority. I will talk about the hedging piece because it's quite important by taking reference to what Matthew discussed about the SORA swap market, which will use this type of convention to calculate interest payment on interest rate swaps. So if at the beginning of February, I drew down the loan and I decided I wanted to fix the amount, I could do an interest rate swap for a month that would pay me the amount from the daily SORA rates in that month. And so it would perfectly offset the interest due on my loan. That would be an effective hedge. And so therefore, if hedging is a priority, the compounded in arrears approach would be the most suitable approach. And we have seen this type of approach piloted by a few banks. OCBC did the very first deal with CapitaLand using this type of approach back in June. Subsequently, DBS did a deal with Wilma using this type of approach that was also paired with an interest rate swap to enable hedging to occur. And UOB did a similar deal, partly referencing SORA, partly referencing SOFR, the US dollar rate, with CapitaLand earlier this month as well. So these are pilots that have taken place using this compounded in arrears SORA rate. The way that I think about this rate is that it's a little bit like your mobile phone bill that you may pay at the end of the month, and you have some usage charges, but you don't know exactly that amount of the usage charges until the end of that month. And so that's kind of how this compounded in arrears rate operates. The next approach is compounded in advance. So this approach is for customers who prefer knowing the exact rate that is payable a month or more in advance of the interest being due. So if we take a look at the diagram on the right-hand side, you see that for the same loan drawn down at the beginning of February with interest due at the end, the SORA rate average that is applied is using the average for January. And so, of course, by the beginning of February, we know what that number is. And so using this approach, the bank can advise the customer of what was the average at the beginning of February. That doesn't change throughout February. And then at the end, the customer pays the interest that is due. And so that's really great for customers who prefer knowing the exact amount that is payable 1 month or more in advance. We have seen local banks pilot programs using this type of rate as well. OCBC some months ago piloted their home loan program, referencing a compounded SORA average over 3 months. And DBS launched a business property loan program earlier this month, referencing the same type of calculation. One important thing to note is that compounded in advance SORA is for customers who are likely to not need efficient hedging of the loan. Because in order to hedge this structure that we have in the diagram here, so in order to hedge a loan drawn down at the beginning of February, you would have had to enter into the swap at the beginning of January, a month before you actually drew down the loan. So while it is possible in theory for a bank to do that type of bespoke derivative transaction, it would be more expensive than the standard derivative transaction that could be used to hedge the compounded in arrears loan. So it is for that reason that this compounded in advance approach is expected to appeal to clients who want to know the interest amount in advance, but don't really need the hedging of that amount. And of course, in the last row on this page, banks are going to continue to offer other loan packages, including fixed rate loans, loans pegged to administered or board rates, as well as loans pegged to other interest rate benchmarks. So how about the way ahead? The immediate next steps for Subgroup 3 and the SC-STS are to publish the recommended fallbacks for existing SOR loans, as well as recommended conventions for SORA loans. That's on track to happen around the end of this quarter. So we've already started working on the specific legal terms that are needed to express these fallbacks and conventions. The next step is also to publish a recommended approach for the solution of existing SOR loans and their transition to SORA. And finally, banks are also focused on putting in place the systems and operational changes needed to originate SORA-linked loans in arrears and in advance loans in volume moving into 2021. All right, thanks everyone, and back to you, Yura.
Thanks, Jonathan. A few questions have come through. So we touched on earlier ISDA and the imminent protocol for swaps. Will loans have similar amendments?
Thanks, Yura. That's a really important question. The short answer is no. The reason that this type of amendment exists at the industry level in the derivatives market is that the derivatives market benefits from a high level of standardization across different derivatives contracts that is implemented by ISDA. And so ISDA can put in place a protocol that facilitates a mechanism that changes these contracts en masse. On the other hand, loans tend to be more bespoke to the needs of the customer. In many cases, I think you may also have hired lawyers to negotiate specific bespoke T&Cs for your loans with your banks. Therefore, there will not be the type of mass amendment mechanism that ISDA is able to put in place for the derivatives market. However, having said that, the subgroup 3 is working on as much template language, common language that is possible, that can be leveraged upon by different banks to facilitate amendment of existing SOR loans to SORA. So which is to say that you're not going to have a very mechanical approach similar to the one that ISDA has put in place, but there will be common language that banks will refer to in order to effect the amendment of SOR loans. So there will be something that banks will be able to apply to the different sets of loan contracts that they have with borrowers in a more common way.
Thanks, Jonathan. A similar question to the bond side. What happens if I do not amend my loan by 2021?
So that is not a recommended approach. If you do not amend your loan by the end of 2021, then when SOR ceases to be published, that loan will fall back to whatever is in the contract today. That may or may not be, depending on how the terms and conditions of the contract were worded. It may be the bank's cost of funds. In some cases, the contract may not specify what that fallback is at all, in which case it will not be possible to calculate interest on that contract. Or it may be some other rate. So in order to have a kind of a predictable transition at the end of 2021 when SOR ceases to be published, all borrowers are strongly recommended to amend their loans to a different benchmark or put in stronger and specific fallback language.
Thanks, Jonathan. A question on loan early terminations. So how would the practice of charging for loan early terminations evolve in a risk-free rate regime when forward-looking term rates are no longer locked in for the loan contract?
Sure. So I think this question likely refers to the practice of charging break costs, which refers to the when a loan early terminates, it refers to the cost to the bank of taking those funds and putting them to a different purpose. So, for example, investing them in a loan in the interbank market or something, for the remaining balance tenor of the loan if the loan had continued to exist. So in such a situation, quite likely banks have different practices for computing break costs, and quite likely banks will continue to charge a certain break cost for the cost of the liquidity, the difference in the liquidity premium that the bank will be giving up because of the breakage of the loan and the need to reinvest the loan funds for a liquidity premium for a shorter tenor. This liquidity premium is measured differently by different banks, but broadly speaking, it comprises things such as regulatory costs, the cost to maintain high-quality liquid assets to support regulatory ratios related to lending, and that sort of thing. So those costs would continue to exist despite the fact that the reference benchmark now references an overnight rate, because banks, generally speaking, don't fund their loans on an overnight basis.
Thank you, Jonathan. Last question for this session before we take a short break. How do we assess time value of money for SORA-based products? For example, a loan based on 3-month compounded SORA, does it matter if the rate is determined in advance or in arrears?
How do we assess the time? So what I think this question is asking has to do with how you assess what the term and credit premium is over a loan that references SORA compounded over 3 months. So I would just kind of refer everyone to the diagram that Yura presented a bit earlier, showing how a benchmark rate, the benchmark rate for SORA is really split up into the overnight rate as well as a term and credit premium, which needs to be added on to that rate in order to get an appropriate rate for a 3-month term or a 6-month term, and so forth. So those premiums can be computed in a number of ways. One way is to look at the basis swap market, for which you have derivatives trades where banks trade SOR and SORA, or SOFR and LIBOR, or SONIA and LIBOR between each other, and that for a given tenor will give you at a given point in time the term and credit premium that you would add on. But there are other ways to calculate this basis as well. The fundamental conceptual point here is that there is a term and credit premium that needs to be added on to a compounded overnight rate in order to receive a rate that expresses the cost of lending over a term, because you can take an overnight rate and compound it for a year, you still wind up with an overnight rate. So in order for that to become a 3-month or 6-month rate, there needs to be some spread. Yeah.
Thanks, Jonathan. And I think we'll touch on an aspect of that when we cover the accounting and tax elements a little bit later on. Well, thank you everyone for staying with us for that initial session, and I hope that was useful to go through an overview of concepts as well as the deep dives that each of the presenters have covered this morning. We'll now take a short break and refer back in a few minutes.
Welcome back, everyone. It is my pleasure to introduce Mr. Mikael Larsen, MD Group Tax and Accounting Policy from DBS Bank, as well as we invite Yura back from PwC back to take us through the tax and accounting presentation. Thank you.
Thanks, Nicholas. So following on from this morning's session, maybe to start, what would be useful is really just to provide an overview, a very simplistic overview of the finance heat map across what most organizations are dealing with, but thank you. Thank you, Mikael. So I recognize this is a little bit of a busy slide, and it will be dependent on every individual corporate or asset manager's use case. But what we've tried to represent is a very high-level snapshot of how finance teams might be thinking about a heat map for this impact. And one of the key things I want to highlight is, whilst we can spend some time talking about the accounting issues and tax issues and disclosure issues, actually from an operational point of view, there can be a significant impact to finance teams because of those changes that we touched on through the earlier session around the mechanism for interest rate change and daily interest rates and compound and advance, compound and arrears and so forth. Whilst we're talking about accounting, the actual mechanical operations of interest accruals and so forth cannot be ignored. So that aspect is quite key. But maybe just starting a really big picture on accounting implications. The key impacts that we're seeing are really on two areas. So the first is on contract modifications, which we'll talk through in a minute. And then secondly, for those corporates and asset managers that do engage in hedging activity, on hedge accounting, there are some more significant impacts. And both of those two areas have been subject to some IASB relief. And I say some because it's important to understand what relief has been offered and how far it goes, which we'll touch on as we go through this session. The other areas of accounting impact can really be summarized as anywhere where, for accounting, we use an NPV calculation or a net present value calculation. And I recognize from the time value question that came through earlier that some people are already starting to think about where is it that I'm using time value and discount rates in the accounting. And as an example, some of those areas include things such as valuation. So thinking about valuation change for products held at fair value. Thinking about where you've got impairment measurements, pension liabilities, any customer contracts where the revenue is linked to IBOR rates, and so forth. So those are some of the examples that would need to be worked through as you look at the inventory. But it's probably fair to say that the majority of impact, or the key impact for most, will be on contract modifications and hedge accounting. As we looked more broadly on disclosures, we've touched on earlier, but we need to start to think about disclosing to investors in annual reports, particularly for debt programs, if you're still issuing debt programs on old reference rates. So there's an obligation to ensure that investors and customers are aware that the rate may disappear and there'll be a new rate. And from a tax point of view, Mikael will go through and touch on some of the things to start to think through implications for tax. As I mentioned earlier, operational impacts are quite key, and we've got 4 areas that we've just highlighted to be thinking about. The first is rate collections, and one point I wanted to emphasize and draw out is a difference that we've seen come through from a number of people that we've engaged with on indices versus term rates. So they're two different things, and maybe just to explain, right now what you see and what a lot of people are using is a 3-month or a 6-month forward-looking here's my LIBOR rate in the future. When we talk about the SORA index being published for 3 months and 6 months, it's the previous 3 months or 6 months daily rates compounded. So they've done that calculation for us, as Matthew and Jonathan have mentioned, which is very helpful, but it is different to a forward-looking 3-month or 6-month LIBOR rate. So please be aware of that distinction when we think about indices versus term rates, because this will impact how you're thinking about those interest accruals and your interest collection. From a settlement point of view, again, this will have an implication to systems, and as we've touched on for Treasury as well. I now wanted to go through, maybe starting with contract modification, just some examples of how this will be impacted, and also what the ISB relief is, before handing over to Mikkel, who will take us through hedge accounting and the hedge accounting relief, as well as tax implications. So for contract modifications or loan modifications, the existing requirement, as some of you will know, it's a little bit esoteric, but the existing requirement is that you discount any change in cash flows. So if you have a contractual change in cash flows, you discount those cash flows at the original effective interest rate. And for a lot of the people in the audience that may not be familiar with the accounting literature and wonder what that is, the original contract effective interest rate is the rate that would effectively discount all the cash flows back to your face value on day one. And for most cases, that's largely equivalent, if you ignored fees, to the actual interest rate on the contract itself. So that was the original requirement. That is the existing requirement. The issue with that requirement is that if it is followed without any ISB or accounting relief, when this change happens, it would trigger a P&L event, because I would now have a change in contractual cash flows, and I still have to discount it at the original contract effective interest rate, and that could, one, it's operationally painful, but two, it could trigger some P&L. So the relief that the ISB has put forward as part of what is being referred to as Phase 2 relief, and this is applicable from 1 January 2021, but you can early adopt if you wish. The relief is basically to allow, as a practical expedient, the discounting of those modified cash flows to be at the revised contract effective interest rate. So we'll go through an example, just a simple case study example in a minute, but the impact of that is that you do not get a change to P&L or to carrying amounts if you change a contract simply because of IBOR change. We'll touch on that in a minute. The ISB has also recognized that there could be some contractual modifications that could arise where there is a change to IBOR as well as another modification. So the two things could be happening at the same time, and the relief is to apply the IBOR-related revised EIR first before working out the impact of the other modification. Again, I'll share this a little bit more in a case study after this. Just important to note that this relief refers to changes that are required by IBOR reform before we apply the new EIR rate. And so what does that mean? So the ISB has provided a little bit of guidance. So they've said, look, the change, when we talk about IBOR related, that means it's a direct consequence of interest rate reform. And as we've touched on earlier, that could be, some examples are where we've triggered an existing fallback clause. We've changed the calculation of the rate, so gone from SOFR to, gone from US dollar LIBOR to SOFR, or any other similar amendment in the rate itself. Now, when we then look at what qualifies, we should also be thinking about whether that change is economically equivalent to the previous rate. So as you recall, we introduced these concepts of credit spread and term spread. So the ISB has provided that examples of what they mean by economically equivalent. So if you are replacing effectively a LIBOR contract with a SOFR plus contract plus spreads as stipulated by the ISDA protocol as an example, that would be economically equivalent. And an addition of fallback provisions is also seen to be economically equivalent. So that's just an overview of what the contract modifications ISB relief is. So hopefully that makes life easier. But I might just walk through two examples just to share what this looks like. So in this first example, I'm looking at a contract, a loan contract, where there is a change purely to adjust the contract for IBOR reform. So in this case, we have a $100 million loan. Let's say it's a Singapore dollar loan, so it's paying 3 months SOR plus 100 basis points. And let us say in this example that the amendment that we're doing is not through fallbacks. You could do it through fallbacks, but what we're doing is we're just changing the rate to be a SORA plus fixed spread plus the 100 bips rate. And we have a change in payment conventions, as we've talked about, so interest no longer being in advance, but rather it's in arrears, and a maturity of about, call it 2.5 years away. So in this example, very simplistically, the original contract interest rate simplistically is, let's say, 1.2% per annum. And again, we've said the effective interest rate, which was the original rate, is also 1.2% per annum, and we have an NPV of 100 mil. As we've amended the contract under the ISB relief, let us say the new contractual interest rate is 1.15, and I know that people will be saying, well, why is that economically equivalent? But we've done it to highlight that there's a difference in effective interest rate in this example. You see that the discount rate now changes to match the new rate, and your NPV is the same. So mechanically, this is why, from an accounting point of view, your loan contract modification would not give rise to a P&L impact. We would, if the relief was not offered, we would have discounted the 1.15% contractual interest rate at the original discount rate of 1.2, and they would give that P&L sort of noise. The next example is where we've now made a modification to a contract, but we've done something else in addition to IBOR reform. So in this example, what has happened is we've looked at a case where the borrower has requested, let's say because of COVID-19, an interest-free window and term extension for final payment. So we're looking at a loan modification where there is a 1-year free interest, and the maturity has moved back from 2023 to 2024. So in this example, the way that the ISB relief would work is the first step is to still work out what is the impact of the new IBOR change, so the new effective interest rate, calculate the present value of future cash flows using that new effective interest rate. And you'll see in this case that we do have a P&L amount, but that P&L amount reflects the value of that free interest period we've given for a year. So we're really capturing the P&L from the other modification we've done rather than the IBOR change. So I hope that was helpful just as an example on the loan modification relief that has been offered by the ISB. And now perhaps to hand over to Mikkel to talk through the hedge accounting aspects and relief.
Yeah, thank you, Jura. Good morning from me as well. So judging by the amount of people who wrote into the IASB, one would clearly assume that hedge accounting was one of the most difficult issues, or at least those that were most on the minds of the corporates that wrote into the IASB. And that's perhaps not surprising because there's a lot of jargon, there's a lot of terminology, and there's a lot of technicalities around how to do hedge accounting. So the way the IASB decided to deal with this in the first place was they broke it into 2 phases. So in phase 1, what they would be considering was what does a corporate do at this point in time before we have to transition to the new risk-free rate. And then phase 2 would be focusing on what do you do once that transition has happened. And broadly, very broadly, what the IASB decided to do was that they gave limited relief. Essentially, they gave relief in the way that you consider the future effectiveness of your hedge. So that means 2 things. So for example, if you have a cash flow hedge, then the ability to project that that cash flow will happen, that you have decided in your documentation would be the hedged item, you would essentially be able to qualify for even if you don't know the exact timing of the transition. So essentially, the highly probable criteria would be met. And then for those who are still on IAS 39, you would also have a relief for the prospective testing of your effectiveness testing. So for those of you who are not so familiar with this, there's essentially two types of considerations. There's one where you're looking ahead, and then there's the actual calculation of ineffectiveness. For the first type, the one where you're looking to continue your hedge accounting, you have a relief. But very importantly, the IASB did not give a relief for the actual calculation of ineffectiveness. So that essentially means that if you do not believe that you're going to have a fully effective hedge, then you would essentially have ineffectiveness. Now, in the period until the actual transition happened, it is my view that it is very likely that not much ineffectiveness, if any, would take place. Because unless you have very clear indication that you would have a difference in timing or a difference in the new rates that you would have, you are likely to assume that you're going to continue to have a perfect hedge if you have one today. Now, in phase 2, there was also some changes that is required. The first one, obviously, is that the documentation will need to change. So once you change to a new reference rate, the documentation will have to reflect your new hedged risk. The second thing is that you will not have to discontinue hedge accounting just because you make an amendment to your loan documentations, or even if you do change your swap to take off the old swap and put on a new swap that has the same terms as the old one but referencing the new rates. So essentially that gives some relief. Also, for those doing a cash flow hedge, there is relief that as long as the reference rate is expected to be reliable, measurable within the next 24 months, you will continue to assume that you can have hedge accounting. Now, there was some debate with the IASB whether to make that period longer, but ultimately they ended up on 24 months being a reasonable period, after which the new reference rate should be sufficiently liquid to be reliable, measurable. So the key takeaway from this slide here is really this. There is an element of relief for your ability to continue hedge accounting, but insofar that you will have an actual difference between the terms of your loans and your derivative, ineffectiveness will arise, and that will have to be captured in the P&L. And I'll give you a couple of examples of how that could arise in a couple of slides' time. So I said hedge accounting would be quite complicated, but it doesn't necessarily need to be. We heard in some of the earlier presentation about the ability, for example, from Matthew, to have the same rate on the loans and the derivative, and how you could also match timing. So essentially, if you do take care to match the rate, so that the fallback rate that you have on the loan will match that of the derivative, that the timing is matched, that the interest rate calculation is essentially the same. So we heard Jonathan talk about in arrears or in advance. And if you don't make any other contractual changes to the loans, you should continue to have a fully effective hedge if you had one today. So it means that you should take care to try and align the changes to the derivative and the loans, both in terms of the terms and the timing, when you transition from SOR today and into the new reference rate. Before I go into a couple of examples, let me briefly touch upon the tax considerations in this. And there are a number here that one could think about. The most important thing is to consider whether tax will generally follow the accounting. At this point in time, IRIS here in Singapore haven't coming up with guidance, but Working Group 8 under the SOR-to-SORA transition work has approached IRIS and is engaging them now to ensure that we will have guidance on how the IRIS will consider the transition. If IRIS follows previous changes to accounting rules, tax will follow the accounting. And that means that any transition P&L, for example, from a derecognition of a loan that Jura talked about, or for example, as ineffectiveness arise in a hedge accounting relationship, would hit your profit and loss and would therefore be taxable either as a gain or a loss.
The second thing to focus on is transfer pricing. In most cases, this would lead to little problems, but for transfer pricing contracts that already reference a floating rate loan, a floating rate loaning contract, be that SOR or be that US LIBOR, or whatever it is for those, these are cross-border transactions, you would of course need to change that documentation to take into account the new reference rate. And one would therefore also need to consider how does one do benchmarking. In the world of tax, to ensure that you can document that you have an arm's length transaction, quite often what happens is you find benchmark transactions. But as we're transitioning into a new reference rate, there may not be much historical data to go from, and so one would have to consider how one would do that. The additional things mentioned on this slide I would broadly characterize into operational tax issues, which we believe should not have significant impacts, such as stamp duty and withholding tax. You could, of course, consider that some of these contracts, if they were to be subject to stamp duty as they were first taken on, as they get repapered, a new stamp duty could technically arise. This is one of the things that we'd like to clarify with the IRS. At this point in time, it is just something to take note of. So to summarize this slide, at this point in time, the expectation is that tax would follow the accounting, and therefore not only would there be a transactional P&L, a transitional P&L, but it would also have a tax implications. But this is a guidance that we're seeking from IRS. Now let me now turn into a couple of simplified examples of hedge accounting to show why it's so important that the timing and the fallback rate be the same for the derivative and the loan. So by way of background, if you take an existing hedge accounting relationship here, and what I've chosen to do here is I've chosen to take a floating rate loan that references SOR. And so we have a loan that references SOR, which is then being swapped into a fixed rate payment. And so if you look at the left-hand side here, you will see the profile of the swap and the loan. And just visually, you will see that they offset each other, and therefore you would expect to have a good, strong, or perfect hedge. If you look at the top right-hand corner, from a cash flow point of view, once you take into account both the loan and the derivative, you will end up paying fixed throughout the loan. And so you would expect your P&L to reference that or replicate that economic reality. And in this case here, it does, because you have in a cash flow hedge the deferment of the mark-to-market on the derivative to equity, and they are then put back into P&L to take into account that if interest differential between the floating rate and the fixed rate, so that you end up showing a fixed rate payment in your P&L. So this is essentially what you want hedge accounting to look like. You have the economics reflecting also the accounting in this case here. Now let's see what happens once you transition. In the first scenario here, we imagine that all terms are matched. And so again here, what you'll be able to see is that the profile for the loan and for the swap, while there is a break as we transition to the new, the break and the new forward curve looks identical in these two cases here. And so once again, what you have, if you have a situation where economic matches accounting, because you have the ineffectiveness, no ineffectiveness, and the full mark-to-market of the derivative being deferred in equity. So this is a situation where the timing match, the rates are the same, and there's no other changes to either the loan or the derivative contract. But now let's say that we have a different fallback. So for the loan, we fall back to something which is not SORA or fallback SOR, but instead, for example, cost of funds. What would then happen? As you can visually see on your left-hand side, although it might not be fully clear, the profile now looks slightly different on the loan and the derivative. And as a result of that, the payment that you will have will also now have an interest differential, which is not fully catered for. And so your cash flow profile would no longer be that of a fully fixed. And the accounting reflects that in this case here by showing both an amount of ineffectiveness that will come through, and that interest differential will also come through period by period. So essentially what you will have is you will have a part of your derivative which does not match the cash flows of your forecasted part of your loan, and that ineffectiveness would yield your profit and loss. Will that be large, much or little? Will obviously depend on how different the future structure will look like of the loans and the derivative. A different scenario here is where the timing is different. So here, you might fall back to the same scenario here, the same rate, but the timing is different. And therefore, obviously, in that period where you haven't transitioned, say in this case here, the loan, but you have transitioned the derivative, you would expect to see some ineffectiveness come through to the P&L, and that is essentially what you're seeing here. Once both are transitioned, you should have the ability to once again get a strong hedge and therefore have the amount flowing through the P&L that matches that of a fixed rate payment. So looking at these two in combination, you can see that there will be both an impact on a difference in timing and also in the difference of the fallback rate. So that's it for the hedge accounting part. There are a lot more implications than just the ones that we called out here. We deliberately kept it relatively simple so that the concept of making sure that the terms match is the key focus of this. As some of you wrestles with issues such as cross-currency swap or different types of interest rate environments, for those of you who have transaction outside Singapore, other issues will arise. We have also not covered things like option contracts, but the basics here is the message is clear, try and align the two things. I now have the pleasure of moderating a panel with my 4 other presenters today. That you've already heard from, so there's no need for me to introduce them again. And the benefit here of being the moderator is always that I don't have to answer any of the questions. So I'm grateful here that we got a lot of good questions, and I'll try very carefully to pick out the ones that are by far the most difficult ones so that we can see if we can rattle my co-speakers here. Let me see, there's a bit of change in this. Okay, so the first one here, I guess could go to Europe, but maybe Jonathan has a view on it as well. So the question is, from an accounting perspective, how can interest accruals be calculated in the compounding in arrears SORA approach when the interest rate is only determined at the end of the period? So a very practical question.
Yeah, thanks, Mikkel. So if we look at the accrual, so let's look at an example where we're at the end of September and we have, let's say, a 6-month interest payment due at the end of December, and we have this issue where we don't know what that final payment will be. But at the end of September, what is available is we do know for the last 3 months, so 6 months contract from July to December, that was the interest period. We know that at September, there are published indices for the 3-month rate. So we know that there's published indices for 1 month, 2 months, 3 months. So you do have available a basis to calculate the interest for these 3 months. Now, it is absolutely right that that won't be the final interest rate. It will change from here to December, but at least you have the best available information at this point in time based on the available indices.
If any other presenters wants to chime in, just let me know.
I think this depends on how your accounting system accrues interest. For accounting systems where interest accrues on a daily basis, then that system would then have to accrue interest using a daily changing rate, which is each day's SORA rate. So to the example that Yura spoke about, for those 3 months from September to December, one way to approach it, and there are a number of ways, one way to approach it is to take the daily published SORA rate, which is published every day at 9 in the morning, and accrue interest for each day at that rate. And so at the end of December, you have 3 months worth of accrued interest. And at any given point in those 3 months, you know how much accrued interest you have on that loan. Now, the actual compounded rate is not known until the end of March, which was Yura's example. So there may be a small difference between the accrual, which using the method I described is a simple average and not a compounded average. But that difference is small. The difference between simple average and compounded average is small, and this has been analyzed by a number of different industry groups.
So just maybe I could ask Jonathan and Yura a natural follow-up question, which is, would it be correct to say that the system implications of this is something that companies would have to consider sooner rather than later? Have you seen systems that can already cater for some of these things here already, or is it something that the vendors are also thinking about at this point in time? Yura, maybe I could start with you.
It's a great question, Mikkel. So yes, vendors are considering the implications. It does vary across the market and different vendors. So our strong recommendation would be to engage in dialogue with your vendor to understand how the vendor is assessing the rate, particularly if you're using treasury management systems and GL systems that rely on these interest accruals.
Okay, very good. I'm mindful here that a lot of the questions, not surprisingly, are related to accounting, but I want to find something where we can ask everybody. So maybe I'll go to question number 3 here on my screen. So to the entire panel, but maybe I can start here with Kipun. Maybe I should start with Jonathan here. How do banks price swaps from floating to fixed now that the SORA is backward looking? I don't know if anybody, maybe Matthias.
Yeah, sure, I can take that question. So I think the swap market is, I would say, pretty straightforward. It's always based on expectation of future rates, and that was valid in a LIBOR space, and it's still valid in a SORA space. So it's just that the fixings or the reference rate that you will be using for your swap are fixing at a different point in time, but the valuation and the pricing of these swaps is still based on the expected projected path of interest rate. So I think clearly it's not really a concern for derivatives. And after that, to measure the actual cash flows, obviously you will need to look at a slightly different methodology compared to the classic SOR or LIBOR-based swap. But again, that part, especially if you refer to like specific MAS indices, will be quite easy to follow and to compute.
Very good. The next question, I think, is for myself here, so you should clarify what I said for the tax part of it. So the question goes to myself: if loans are applied under the relief, no P&L impact, then why is there a tax impact as mentioned? And I imagine what this question is also thinking about, if there's no ineffectiveness in the hedge and you apply what I call the phase 1 relief, why would there be a tax impact? There wouldn't. So the point here is any P&L that is being generated either upon transition or after transition, insofar that there is an accounting impact, that impact would also, if IRS follows normal rules, would be subject to tax as well. That was the clarification that I wanted to make. Okay, let's go to this question here. Yura, I think this one was for you as well. There are a number of questions here that relates to accounting. So if I have a loan referencing compounding SORA in advance, but derivative market is only referencing compounding SORA in arrears, am I able to apply hedge accounting? Is there an economic relationship criteria? I touched upon that briefly, but I don't know if you yourself wanted to elaborate a bit on whether that bit in itself could create ineffectiveness and whether that would be significant.
Yeah, thank you, Mikkel. So yes, it would create ineffectiveness, as Mikkel had touched on in the slide and the example. The one point I wanted to draw on is the point that Matthew referred to, which is this point about forward rates. So when hedge accounting is done, let's say we're looking at a 3-year loan and a 3-year swap. Hedge accounting requires you to estimate what the SORA rate will be over those 3 years, and on both the loan and the swap. So when you're doing that over 3 years, the question is, do I think compounded in advance versus compounded in arrears will be different in next year, the year after, and the year after? And actually, as you look forward, the rate won't be that different. Therefore, hedge accounting will not give you a lot of ineffectiveness. But in the very short-term part of the curve, so if you looked at the next 3 months, as Mikhail's example had highlighted, in that very short term, there is a difference. So you'll get some P&L, but we don't expect your hedges to fail because of this. It would just create some hedge ineffectiveness in P&L.
Very good. Thank you, Jura. The next one, maybe for Jonathan. See if I get it right this time, Jonathan. For compounded in arrears SORA loans, interest rates are computed based on average rate for the past period. Is there any difference in rates between a 3 or a 6-month loan? Will there be a term adjustment? I think you answered that in part before, but...
Sure. Thanks, Mikhail. So I think I would refer everyone back to the diagram in the early parts of Jura's presentation that shows that in order to get something that is equivalent to an IBOR type rate for a term, like a 3-month term, for example, you would need to add on a term premium and a credit premium to the overnight rate that is daily SORA. So the answer is that if you look kind of through the economic cycle, there is a term premium and a credit premium to be added to daily overnight SORA in order to get something that resembles the SOR rate that we are used to using.
Maybe just to touch briefly on that point. So the term adjustment, as Jonathan has outlined, is a mechanism along with the credit adjustment for equivalence where you have the old LIBOR rate. So it's a transition thing. We have LIBOR contracts, we need to find a way to make them equivalent to this daily rate, and so we add those 2 adjustments to get them equivalent. Over time, so if we look forward 3 years or into the future, where we're past that transition and just writing contracts on SORA, there's arguably no need for this term adjustment. You would just have SORA plus margin, because I no longer need a reference to this old rate. So it's very much a transition type point.
Very good. Thank you, both of you. A question for you, Kivong. If a company has issued a fixed rate bond and also entered into an IRS or cross-currency swap referencing SOR, other than dealing with bond terms and swap terms, how will the issuer be impacted by the SOR-to-SORA transition? So a fairly broad question.
I'm assuming that you've issued a plain vanilla fixed rate bond. So in that case, the bond's coupon being fixed rate would not be impacted. It remains the same. Now, to the extent that there is a derivative that is overlaid on the underlying, then you would need to look at that derivative. And if it's a SOR-based derivative, then that will be impacted. Now, on the derivative itself, and to the extent that there is tax and accounting implications, that also needs to be looked at. We would recommend that if that's the case, do talk to your bankers, talk to the professionals, or auditors as well as lawyers to see what needs to be done and how it can be correctly looked at and accessed.
Very good. Thank you.
Wait, maybe I just want to add one point here that's quite important. So one of the challenging part is always potential mismatches between underlying and derivative, right? So in a sense, if you have the chance of having a fixed rate derivative not impacted by the transition, it means you only need to take care of the derivative portion or the derivative part, which actually you can do well ahead of the transition, right? So if you have, for example, a fixed rate to SOR swap currently to convert the fixed coupon of your bond to a floating rate, you can actually today recontract that derivative with a SORA reference. So that going into the transition, basically you have reduced your stock of transaction and you reduce your potential operational or economic impact upon the transition.
Excellent. Here's another tax question that I can very quickly cover off. It's one of those dangerous ones that you never want to get. Do you see any major tax issues in other jurisdictions outside Singapore? That's hard to answer because there are many jurisdictions. What I can say, though, is that we've heard scarcely little from tax regulators around the world right now. The US is the only one that I'm familiar with who's coming out with clear guidance around the relief that they're giving. And here, broadly, there's also a following of tax and accounting. Beyond that, there isn't an awful lot that we've heard. So regrettably, this is one of those watch this space where you would have to follow up in those specific countries that you're in. Okay, I think the next one we've answered already. Here might be one that I would need the answer for as well. So it's a derivative question again. Let me see if I can reframe this a little bit. Why is the IRS against SOR offer and SORA overnight interest rate swap offer not reflecting any SOR-to-SORA basis? Should I read that to you again? Why is the IRS against SOR offer and the SORA overnight interest rate swap curve offer not reflecting any SOR-to-SORA basis?
Okay, maybe I would need a bit more context, but I think in practice, if you have both markets, and right now actually you do, interest rate swap against SOR and interest rate swap against SORA, the fixed rate you would get for these two swaps would actually be different, right? And the difference between these two rates is actually what we call the basis, and the basis is typically the cost of converting a floating rate to another floating rate, right? So that basis actually exists. The reality is that this SOR-to-SORA floating rate swap is not yet very developed. What will develop first is simply a SORA interest rate swap, so from SORA floating to a fixed rate. But from that, you can very easily add one step, which is convert that fixed rate back to SOR. So you end up having a SORA to SOR floating rate swap. And these instruments are actually, it's important to highlight it, these instruments are available today, right? So if you want to enter in such kind of transaction to reduce your exposure or to try out some SORA-based transaction, it is possible to do that today.
Thank you. Here's a broader question that maybe I could address at, well, any of you, but Kee Pong perhaps is, let's see if it, when is the term SOFR and term or SORA rate likely to be available?
Yeah, to some extent, I've touched a little bit on that. Currently, that's not available. It is work in progress. If it's available, then it would be kind of very natural to replace SOR because that's what market participants are used to. For the bond market, that particularly in Sing dollars, that is not too worrisome given that floating rate instruments are really exception. It is predominantly a fixed rate market. But having said that, of course, there are some instruments that would reference SOR and therefore a reference to a benchmark rate would be necessary. So those instruments would be reset instruments where it's originally fixed, for example, and resets to a floating rate. Or it could be resetting to a fixed rate but based on the spread of the reference. Right, so in the past, it's common to see reset to the fixed rate equivalent of a term SOR plus the spread, right, or initial spread. In those situations, you can, in the absence of a term reference, in the meanwhile, you can reset to a certain fixed rate, right? Or you, as I mentioned, in other markets, the treasury equivalent would be used. And in the Singapore context, we could consider possibly SGS plus some spread, because SGS securities are very liquid and active, right? Although we do know that for hedging purposes, that's not being used, right? So these are some of the options that the market can consider to do that. Jonathan mentioned a little bit about break funding. It's less common, much less common in the fixed rate bond space. There is one situation whereby that could be affected, and which is what a market calls a make-whole premium, where a reference rate is used for discounting, should an issuer decide to redeem. But those cases are rare, more rare and exceptions. And to the extent that that's being used, then again, it's for the market to think of how you can use a proxy reference rate to discount. Right? Otherwise, the methodology and the concept and the principle of deriving at what would be a redemption price remains unchanged.
Thank you.
I think, sorry.
Yeah, please.
On that point, I think one aspect we should actually address is that the exact answer could be never, actually, or at least not for each and every market, right? So typical expectation from everyone would be to say, okay, you have your new benchmark rate, which is either SOFR in the US, SONIA in the UK, or SORA for Singapore. Why don't we just create a term SOFR, and that will be easy for everyone to use? It actually has some shortcomings that regulators in particular are not necessarily comfortable with in terms of liquidity, in terms of relying on a market that might not be developed enough, and basically might have some of the shortcomings that LIBOR would have to start with. So I think it's very important to not create false hopes that term SOFR or term SORA would be the perfect solution to all potential issues. And I think, again, the view from everyone here is first to get ready on the compounded rates, and eventually if the term rates come, it would be a better situation to be in. But it's important to assume they won't be here, I would think.
Very good, thank you. A question that seems to be supported by a number of people, and maybe I start with Jonathan, but is for the credit adjustment to the SORA, is this a standard adjustment determined by a body, or is the bank the one determining the credit adjustment?
Thanks, Miguel. That's a good question, and it's a question that has come out time and again in different webinars when we have such panels and webinars. In other jurisdictions, such as the US dollar market and the sterling market, the industry working group has recommended that banks use the ISDA spread, which is calculated so this is the spread that will be applied to derivatives to convert them from IBOR-based to new rate like SOFR, SONIA-based derivatives. And that conversion spread is calculated as the 5-year historical median, the difference between the relevant IBOR rate, such as LIBOR, and the new rate, such as SOFR, compounded in arrears SOFR. In the case of Singapore specifically, the industry is still looking into the appropriate approach for calibrating such a spread between the old rate SOR and the new rate SORA. So there are some approaches that other countries, other jurisdictions have already adopted, and currently the study going on is whether these are the right approach for the banking industry in Singapore to adopt, or whether there should be some different approach taken here.
Thank you, Jonathan. I want to get you an accounting question, but there seem to be a lot of questions that deals with market conventions. So here's another one of those, and maybe I can start with you, Matthew, and Jonathan may have you as well. what happens if the loan and swap conventions don't match? And then there's two questions. Will companies lose money? And then the second part of it is, will hedge accounting fail? I think we touched upon the second part about why hedge accounting may or may not fail, but I think it's important to address the first one about, will companies necessarily lose money? So who dares to answer that?
So I can start answering, and you guys can follow suit. So it is a likely possibility that loan and swap do not fall back on the same rate. And that's, I think, one of the obviously key issues we've been trying to cover this morning, simply because there are two different contracts potentially dealt with different entities under a different legal framework. So based on all these variables, it is possible that the rates are going to differ. And we can take maybe a simple example, that the loan falls back to the a simple average of SORA on the loan side, whereas your swap falls back to compounded SORA. So that can be one difference. Or if the term SORA that we were mentioning comes to market and actually is used as a benchmark for the loan, while your swap still goes back to SORA compounded. So in this kind of situation, there will always be a possibility to adjust your derivative or plug in an additional derivative to match your loan floating rate. So as long as your loan is using I would say, a market benchmark and using SORA in particular, in most cases, whether it's like average or in arrears or with different shifts and all these features can actually be tweaked and replicated in your derivative. Now, does it come at a cost or a benefit to you? It's obviously impossible to say today, but I think two aspects that are very important. One is that it is very likely to be a one-time pain or a one-time adjustment, because once you have done this plugin, basically you have no more variability. And I think the key important point, and that leads us to the hedge accounting part, is that as long as you can have an instrument matching your loan and your derivative, you don't have cash flow mismatches, and I think that's the key element.
Thank you. Okay. I promise you I'll get to you, but there's a couple of tax issues again, so let me just clearly get those out of the way. The first one is, would ABS be engaging IRS to confirm the tax treatment? Yes, they will. As I mentioned earlier on, Workgroup 8 under the SC-STS have already arranged to meet with the IRS, and the ABS tax committee will be joining us. And then any feedback will be taken back through ABS. So yes, we will be addressing IRS, and hopefully some guidance will be available in the near future. The other tax question I think is a good one is, the question goes, for transfer pricing, any change in the existing terms of a loan would be treated, I guess the question is, would any change in the terms of a loan be treated as a new loan? And accordingly, will the change of our amendments of existing intragroup loans contracts result in new analysis? I think what this question is aiming at is, does that mean that just because you change your reference rate, you'll have to go and prove everything again? Reality is that depends by which tax regulators you're dealing with, of course, but I think a case could be made that because there is an attempt to create an economic equivalent, and what I was mentioning about the benchmark was, how do you prove that your transaction equates to existing transaction, which would be historical ones, which would be probably following the old rate? I think there is an argument to be said that because there is an attempt to create an economic equivalent, this in itself would prove that you would be at arm's length if you were at arm's length already. But first of all, tax authorities, of course, might take a different view on that. But as you go through time, I guess there is a risk that this disconnect happens. And at some point in time, for sure, you want to make sure that you do your new benchmark against the new reference rate. But I think at the point of transition, it might be hard to find an existing benchmark that references a new reference rate, and therefore the economic equivalent might be a good enough argument to suggest that you've proven that you're arm's length if you already were. Okay, I promised you an accounting question, so here's one for you. If I transition my derivative, but not yet my loan, will I get a day one profit and loss gain of my derivative, and how do I account for that day one gain or loss?
Thanks, Mikkel. So as we've touched on with the ISDA protocol, the credit spread adjustment, term adjustment, the objective of the industry working groups, the banks and so forth, is really that there is very little or no day one P&L. So there's no value change when you go from LIBOR to this new rate. So you're trying to get to economic equivalence as much as possible. So because of those two additional spreads, we're not expecting a significant day one P&L issue on transition, if any.
Very good, thank you. Here's one that I think multiple could be answering. Should SC-STS be issuing an industry guidance for a SOR-SORA spread for legacy loans transition to minimize unintended economic value transfer in the market? I mean, obviously it lends itself mostly to Jonathan, but I guess other people could have a view.
Thanks, Mikkel. The SC-STS is looking closely at this issue with regard to common guidance for a SOR-to-SORA transition spread. It is an area that is being studied, but that is still a work that is in progress. The SC-STS and MAS as well, which is represented in the committee, have taken note of developments in other jurisdictions where the industry working group has come out with such a spread.
Thank you. There are many questions for you, Jonathan. You're a popular man, but so I'm trying to find a couple that is not for you. Maybe I'll one here from Matthew. It was indicated that you can customize observation periods, compounded or simple, averaging, etc., to derivative. I thought ISDA had recommended a standard 2-day backward-looking shift and compounded back in his paper. I'm assuming it means in the paper in November 2019. So he's questioning whether you can customize, how much you can customize derivative, because there was a recommended 2-day backwards-looking shift.
So I think probably 3 parts to that answer. So one is for existing contract that will actually follow the ISDA protocol. So here it's very scripted because you want to change as little as possible in your existing contract, and actually you only want to change the waterfall mechanism. So how do you get to your fallback within your definition? And that gives very limited leeway for any other change. So that's for existing contracts going to, I would say, mechanical fallback of the new ISDA definition. Now looking at SORA as a new market. So I think two aspects. One is the conventions for the interbank market. So it is true that for the interbank market, we tend to have this so-called T+2 payment date, meaning that your payment date is actually not on the last day of your calculation period, but it's 2 business days after the end of your calculation period. It doesn't mean that this method has to apply for each and every swap based on SORA. And that's what I meant earlier by the amount of flexibility you can bring to your swaps. The typical parameters you can adjust, and we won't, I guess, get into all the technical aspect here, but it can be, for example, an observation period shift or a lockout or look back. So different technical terms which simply mean you are adjusting the exact SORA fixing that you are observing in your swap. And by and large, it is possible to adjust your swap. So it might affect the pricing, obviously. It might affect the liquidity. but it is still doable to adjust your derivative to reflect those changes. So even I think on the bond side, we've seen a lot of different conventions, sometimes like 5 days, sometimes 2-day shift, sometimes you have a lockout, meaning you don't observe the last few fixings. So all these actually can be replicated into the derivatives market.
Thank you, Matthew. Looking through these questions, there's a number of more fundamental questions that I think, given that this is a tax and accounting seminar, we should address. So the next couple of questions will be on tax and accounting. Jura, I think we might need to clarify a little bit here. The question has disappeared. Bear with me, everybody. There was a question. Yes. What is being charged one time to P&L or amortized? So I think this question goes to the point that maybe we need to be clear around if you have derecognition, what could be your P&L on transition if you failed hedge accounting. So I think this question goes to what could be the potential transitional P&L and where could be some of the P&L that you would have that you wouldn't otherwise have had if you hadn't had the transition. So maybe we need to be a little bit clearer around what those could be. So we spoke about hedge accounting, we spoke about derecognition, so maybe we can just cover those again.
Yeah, maybe just to expand. So if we simplified the instruments on your books into those that are held at cost or amortized cost, so typically loan products, then as we've touched on, the ISB relief mitigates the P&L impact that you would get on those products from transition. So the point we made around loan modification and the relief being provided to mitigate that impact. If we looked at then the mark-to-market world, as we've touched on, for the majority of products, we're expecting that P&L is very, very low or zero because the value transfer mechanism that's being built into ISDA will capture that the difference between LIBOR and the new rates. It is possible that for very long-dated contracts and option product contracts, there will be some P&L, and that is being worked through. To the extent that that P&L arises on your mark-to-market book, it would be taken to P&L. We don't see any relief being offered to mitigate that, but as I say, we're not anticipating that to be a very significant portion.
Very good. And maybe I can ask you another one. You're here. There is a question that asks. Sorry, these question moves a little bit, so you'll have to bear with me. Will fallback rate SOR fail the economically equivalent test for accounting?
Yeah, it's a good question, and I assume we're making the link to the contractual modifications relief, and in that event, no, our initial assessment is that we believe it follows that requirement, but it is unique, as we touched on. So this is a unique circumstance that is different to what the ISB had originally envisaged, given the global IBOR change. So we would recommend that is a conversation that is undertaken with auditors and accountants early on.
Very good. And if you bear with me, there's a couple more. I'll just give you one of them, then we'll move on. Are there expected new changes in the valuation models for derivatives and underlying hedged loans and bonds? So I guess it goes everywhere, and we can then, Jura might have something to add, but.
Yeah, I think for derivatives, no fundamental change. So if you enter into a swap today based on SOR, you will need to value that swap based on the underlying SOR swap market. The same will apply once you are moving to SORA. So you will end up having a term structure or like market levels that are available, and these rates can be used for valuation of your derivatives.
Okay. Anything on bonds or loans that we want to add?
Maybe just briefly to add to Matthew's point. So I think for larger corporates with big treasury departments, what would be worth thinking through when your treasury system is currently you'll have some feeds coming through, rate collection feeds for, as Matthew's indicated, say SOR today and LIBOR today. It is about thinking through how those feeds would change to reflect both the cash flows and the discount rates using these new rates. So are you collecting now feeds to go into the treasury system for SORA? How are we going to build the forward curve and so forth?
Okay, thank you. Here's another interesting question here, which I guess could go to Jonathan. Why did ARRC recommend a look back without observation shift for business loans, which are different from FRN look back with observation shifts?
That's a good, very specific question. So the ARRC, which is the US Alternative Reference Rates Committee, that's the committee in the US that is sponsored and endorsed by the Federal Reserve, and they are looking at the transition between US dollar LIBOR and SOFR. They came out in the last month or so with recommendations for US dollar syndicated loans and US dollar bilateral loans. And in these recommendations, and establishing the context, in these recommendations, the mechanism used to notify borrowers of the interest payment in advance is recommended to be a look back. So it's one of those several conventions that Yura had on his slide earlier on today, where he listed out things such as look back, observation shift, payment delay, compounded in advance. And what they came out with was a look back, which is providing the borrower advance notice of payment by roughly 5 business days or so by, for each fixing, looking backwards at the rate that was published those 5 business days ago. So therefore, at the end of your interest period, you have 5 business days notice, because 5 business days before the end of the interest period, you will know what all of the interest fixings are. In the bond market, one commonly used convention, including the convention used by the MAS-issued SORA floating rate note, is an observation shift, where you look backwards to fetch the interest rate fixing, which is exactly what I just said a little while ago for look back, but you also look backwards to fetch the day counts used to weight those individual daily fixings. So that's the difference. To my understanding, the reason the US committee recommended the look-back approach was to simplify the mechanism in the loan systems and in loan documentation that would need to be constructed in order to reference the observation shift instead of the look-back approach. Basically, the look-back approach is simpler, particularly in the case of syndicated loans, where you have a number of different parties involved in who need to receive interest computations for the syndicated loan. Additionally, when you have an observation shift, you may wind up in a situation whereby your interest periods, your observation periods do not exactly line up back to back because of the presence of public holidays that move them slightly off of the interest period by 1 or 2 days. So because of that additional complexity, they went for the look-back approach rather than observation shift.
Thanks, Jonathan. And we did discuss this when we were preparing the slides, and you'll notice in our slides we've kept fallback, look back, and observation shift as one window. Because that nuance is so specific, we just wanted to keep it a bit generic. But thanks for the question, and thanks, Jonathan, for elaborating.
That was a very, very elaborate answer. Thank you for making us wiser. Here is maybe one for Matthew again. I want to make sure that we clear as many of the questions which are a clarification point rather than getting into more minute questions here. So this one is quite generic. How do you derive the tenor for swaps based on SORA? i.e. the compounded 3-month SORA is not the same as the 3-month SOR. Let's see if we can get that question to come up. I skipped down a bit here. So maybe I'll read it again. How do you derive the tenor for swaps based on SORA, i.e. the compounded 3-month SORA is not the same as 3-month SOR. So how
okay,
can
so
you
I
do
guess
that now?
yeah, it's probably like two questions combined. So again, like the SORA market and the SOR market will ultimately become two different markets, right? So the SORA market will have no reliance per se on the SOR market, and that's the whole point, that the SORA market becomes a standalone market. Where I think, especially in Singapore, where having overnight rate is something a bit new to the derivative market, unlike what we've seen in Europe, in the US, or in other Asian markets. Using an overnight rate in derivatives is a little bit different, but fundamentally it doesn't change the logic of derivatives. So derivative, you project an unknown interest rate in the future, and you discount that value to today. So that's valid when you have quarterly payments with a quarterly rate, but likewise it applies when you have quarterly payments based on an overnight compounded rate. So the math behind are changing a little bit, but the logic is fundamentally the same. You project cash flows and you discount them back to today. Which means in practice for SORA, because you can have different frequency of payments, monthly, quarterly, semi-annually, annually, but you are going to refer to the same set of fixings over that period. So ultimately, you will have quite a lot of flexibility to adjust the frequency of payment. So it was very uncommon to have a 3-month SOR paid on a monthly basis, but you could very well have a SORA compounded paid on a weekly basis, on a monthly basis, or on an annual basis. So that, I would say, distinction between the tenor of the underlying rate and the frequency of payment doesn't really matter anymore when you move to an overnight rate, which ultimately gives more flexibility to the user.
Thank you. Let me see. This one here is panel. Since it is recommended to use index instead of daily compounding, does it mean look back with observation shift is more recommended than look back without observation shift? Let's see if we can get that question up. So since it is recommended to use index instead of daily compounding, does it mean that look back with observation shift is more recommended than look back without observation shift?
So maybe I'll try to start answering that question. So I think one of the new challenge that didn't exist with SOR, but that likely will exist with SORA, is to ensure that these details in conventions and calculation methodologies, such as observation days, fixing days, observation period shift, and all that, all these elements were not really prevalent in SOR, because it was very simple. You just have to match two fixings. And because of that, it gives a little more room for mistakes or mismatches, rather, between an underlying loan or an underlying floating rate note and the swap. What if one has shifted by 2 business days and the other one by 3 business days? Or the observation shift versus look back. So I think earlier I referred to the use of the MES index as being an easy way to solve that problem. Because ultimately you don't need to bother so much about all the more technical details, and you just know that you are using the same reference index for both contracts. Which means in turn that once you use that, you care much less about I would say the detailed implementation of your shifts or your calendar holidays or your fixings.
Thank you. There's a good question here that I think deserves clarification. So it's a bit further down in the order here, but it's a relatively generic question. Can you explain for fallback SOR? So can you explain what fallback SOR is and the weakness in using this fallback rate other than the fact that it is not permanent. So in other words, why would people ever choose fallback SOR over SORA? Who wants to take that question?
Maybe I feel it's impacting derivatives quite a bit, I don't know. But so yeah, and I think that's why the overall recommendation is as much as possible to move to SORA, because that will be the long-term solution. Fallback SOR will only be here for a few years, which means that you may solve the problem temporarily, but you will still need to address it fundamentally at a later point in time. I think for participants, also the specific technical challenge with fallback SOR is that SOR is synthetic rate, right? So synthetic rate means it's a combination of two elements. One element is LIBOR, and the other element is foreign exchange swap, so converting dollar cash flows into Sing dollar. Once your dollar rates component moves to a compounded rate, that component will only be known towards the end of the period, while you need to enter into your FX swap at the beginning of the period. So basically, you are creating a synthetic rate with two components, but these two components cannot be entered into at the same time, which is, even from a trading perspective or a bank's perspective, quite challenging. So again, it's here because it's facilitating transition for complex cases, but it has, in my view, a few, I would say, technical complexities that should not make it the preferred route.
Very good. Anybody wants to add to Matthew? Okay. Let me see here. There are a couple of clarification questions and accounting again. And again, I want to make sure we capture those. So Yura, if it's okay, I'll ask you another one. It's a bit further down in the order here, but the question goes, in a fair value hedge, so it would be fixed to floating, in a fair value hedge of a fixed rate instrument, can we assume that there is no concern about timing mismatch, as the hedge risk would reference the hedging instrument benchmark? So hypothetical derivative, I'm guessing.
Yeah, it's a very good question. So the key point here would be to be comfortable that the hedged. So let's say you're looking at a hedge of you have some fixed rate bonds, and you've hedged the interest rate risk. So typically, the interest rate risk being hedged at the moment matches that of the swap. When we talk about a timing change, what will happen is, going forward, you want to redesignate that hedge to say, let's shift the interest rate that I'm hedging on the bond from SOR to SORA. And so the question is, at the time of changing, so let's say you've changed your swap from SOR to SORA, is there a benchmark in the market for SORA? Now, we think for most practical purposes there is, so you should be able to change and align, therefore no issue. But it is something that you should consider for each of the markets you're in, to make sure that there is actually a benchmark in that market for the swap that you've entered. So SORA is a benchmark in that market.
Very good. And here's somebody who wants to test us, Yura. So the question goes, is there any impact to IFRS 16? So we're no longer in derivative and financial instrument land, and the tax deduction for operating leases. So if you take the accounting bit, I can easily cover the tax bit.
Yeah, thanks, Mikkel. So for lease contracts under 16, there are some leases that have a variable component of the lease. So you will pay lease payments that are linked to a reference rate. So it could be linked to LIBOR and so forth. They're not very common, but those are the ones where there will be an impact, and then there will be a change in the calculation of the lease accounting, the calculation supporting the lease. But apart from that, we don't really see a significant 16 impact.
Yeah, and that's been when we did our analysis, we found very much the same, and therefore, of course, the tax follows naturally. But again, insofar there was one, there's also some relief given in the standard about how you can treat this as a prospective change, so you wouldn't have an immediate P&L. But insofar that you would have a P&L, again, the negotiation with IRS will, or the conversations with IRS will determine whether there will be a tax impact. For the time being, we assume that what impacts the P&L will also impact the income tax return. Okay, there is one here that seems to have had some interest here, which is your slide shows credit spread and term adjustment as two different components. Is there an IRRC will use the median 5-year LIBOR SOFR difference? Does this incorporate the term adjustment, or is that separately negotiated?
I'm happy to take the initial response and turn to others. And I also note there's another follow-up question that said, if LIBOR ceases in 2021, how do we do a 5-year look back in 2026?
Yeah, why don't we take those at the same time?
So we might just combine them, and maybe I'll just explain those 2 points a little bit and ask others to contribute. So when we talk about two components, the term one, in my mind, is actually quite easy. So what that is we have a daily rate now, and we have LIBOR, which is a 3-month rate. So it's apples and oranges, and we need to get them both to look the same. So all the term adjustment is doing is just compounding that daily rate to a 3-month rate. So you just compound daily till you get to 3 months. Now I have two things that are 3-month rates. The difference between those two things, when I look back at time, is the implicit credit spread that banks have been charging. So when we talk about the look back and the credit spread methodology, it is really, once I've calculated the term adjustment to make it 3 months, it is looking back and saying, what has that difference been? And what has that median adjustment been over the last 5 years? Now, to the second question, which is how would I calculate this in 2026, maybe just as so that calculation will happen at the point when there is a discontinuation event. That is when we will determine that this is the point at which we look back 5 years and say, okay, now we lock in the spread. So that calculation then gets locked. Everyone will say, okay, for LIBOR transition, this is the rate. So it's 6 basis points, 8 basis points, or whatever it might be. It would not be something that would be updated going forward and into 2026. We anticipate that we should lock that down in the next 12 to 18 months. Happy to hear other views.
Yeah, no, I think the important point to note here is that this adjustment is only for legacy contracts, so transaction entered before the transition, surviving after the transition, and it's done in a fairly transparent manner. It's published by Bloomberg, so it's observable, and it's fixed at one point in time, basically. So it's not an ongoing concern. It's something that can be addressed at a single point in time.
Thank you, and that takes us right up to the hour. So I want to thank you to my member panelists here for a lot of good answers to a lot of tough questions. There are a few questions that we won't be able to get to here. We'll try and see if we can answer them offline for those of the questions that we didn't get through. But thank you very much, and I'll hand it over to, I think, Aibun to say goodbye to us.
Yeah, thank you so much, Mikael. Thank you, and all you panelists and speakers. So, ladies and gentlemen, we have come to the end of today's session, and we hope you had a useful and fruitful time. Now, today's session has been recorded, and it will be up on the APS website by this Friday, 18 September. So I would like to remind you, please, to complete and submit your feedback of today's session via the Pigeonhole platform. If you have any further questions, as Mikael has indicated, relating to today's subject matter, please send them to sortransition@abs.org.sg. So it leaves me now to thank all you speakers, panelists, Yura, Matthew, Kipong, Jonathan, and Mikael. Thank you for your time with us this morning. And I thank all of you participants for your attendance, and do have a good afternoon. God bless all of you. See you the next time. Bye.